Uh, Thank you. The introduction made me sound old because I'm old. Let me try to tell you quickly what is Telcom Capital, and then we'll get into the things that I would like to cover. And thanks for having me. So Telcom Capital is a normal, non-impact, try to make money venture capital firm. We've been around for about 25 years, and the last 15 we ran away from Europe to Africa because Africa was more interesting and more exciting, and not because any anxiety to help the continent. There's nothing to help. This is a business opportunity. It's a gigantic market. Technology can be transformational, and we need to show the world that it's a great idea to invest in African entrepreneurs. We have about $250 million under management. We're investing out of our second fund, which is $150 million, and our team is in Nairobi and Lagos. So the way I wanted to talk to a bunch of people interested in climate investing is to fundamentally focus on the role of VC in making this space more attractive. And we all know that climate VC is a very relevant part of Africa VC investing. It's about a third, but it's still very small. We have to acknowledge that. And the question that I would like to raise is, how do we attract more capital? Which is the same as saying, how do we generate world-class returns to attract more capital, right? So let's take that view. At the beginning, I think we should be grateful to these two gentlemen, Max Kuviller and Maxime Bayen, who measure for us what's going on for all of us, for the ecosystem, at the big deal, what's happening in the ecosystem in terms of numbers, and it's always good to have good data to talk about things. And their numbers are very clear. Climate tech is difficult to define. It's a little bit of fintech, a lot of energy, some deep tech, some agri and food, some logistics. But overall, it's about a third of the money that we invest collectively in Africa VC every year. And this has been the case for the last several years. So the question of, is climate investing relevant for Africa VC? The answer is, of course it is. It's actually the second largest after fintech. The problem that we have overall, not just in climate, but in general, is that Africa VC practically doesn't exist. So I always wonder, what are we exactly celebrating where we say, oh, we're moving from 3 billion to 4 billion. It's fundamentally from 0 to 0. So we have a general ecosystem challenge of aligning the relative weight of Africa in terms of population, in terms of GDP, in terms of relevance globally to the amount of money that is being spent annually. So the fundamental question is, how do we attract more capital, and more private capital even better, without strings attached, for African entrepreneurs? So I'd like to talk to the VCs fundamentally, but also to the entrepreneurs, to show you how VCs should behave and how we try to behave, right? To go beyond the black box, beyond this question of how do these investment committees work, what are they trying to do? Well, this is what we should be trying to do. So the first point is that we VCs need to focus on what we call fund returners. Fund returner technically is an investment that, if things go well, and they usually don't, but if things go well, if everything works, when we sell that company, the proceeds that we get, not the overall proceeds, that the proceeds that we get are as big as the fund, right? So you would say, oh, but that doesn't happen very often. Exactly, that doesn't happen very often. But our business is to invest every 5 years in a number of companies, knowing that most of them will fail because we go after a high level of risk. But the ones that don't fail have to more than compensate the ones that fail. And so all we need is 2 or 3 of these companies in every fund to deliver a 2 to 3x return. So these numbers that measure 20 plus thousands investing. And as you can see, the companies that deliver more than 10x are actually a very small percentage, 4%. The global number of how many companies a venture capital company looks at before investing is actually, these numbers sometimes are precisely wrong rather than vaguely right, is 178, say 200, right? So good VCs actually look at 200 companies before they pick one, because they're in the business of trying to identify those very few companies that over the next 5 years have a chance, if things go well, to actually return the fund. So at this point, the question is, okay, but I don't have a fund returner. That is fine. Life is great for fund returners and not fund returners, and all the entrepreneurs should get financed. But if you talk to a VC, you should expect that we are looking for companies that have some chance of delivering that return. Okay, so the first way to interpret this odd behavior of the VCs that are so happy during due diligence and then they pass, or are not happy but then they invest, is because what we should be looking for is for those outliers that do not happen very often, but can have the promise, if things work, of delivering this level of returns. So this is the first notion. The second notion is that our experience, and I've been doing this for actually 25 years, but the global experience of venture capital in the 80 years that venture capital has existed is that the main failure factor is the team, is the quality of the founders. Particularly in early stage investment, you spend a lot of time on business models and then usually the companies pivot. So that's not the point. The point is, do I back a human body that has an awareness of a problem and thinks that their solution is better than anyone else's because they have a better cost position of more value to deliver to the customers, but people that has the awareness of a problem and can actually articulate and execute a way of solving that problem better than anyone else. So when you see VCs doing due diligence, what we as VCs should be doing is to spend most of our time to try to interpret whether the human bodies in the founding teams have an ability to go through the journey, right? More than the size of the market. Of course, everything is important. The size of the market, is the market attractive? Can the company win in that market? Is this a good investment? Of course, everything counts. But the key killer or success factor is the quality of the team. So that's another very important point. The other is that when you look at unicorns, so companies that are worth $1 billion or more, it takes a long time to build one of those, right? So it doesn't take any shortcut, so to speak. So it takes years, 8, 10 years. And you need to pay a lot of attention to those and only to those. So when things don't go well, actually VCs do not have an obligation to continue to support a failing initiative. The good thing to do is to fold it and maybe back the same people but with a new idea, rather than wasting time keeping zombies alive. So there is an important point of saying VCs is a selection business, not just at the time of investing, but at the time of the portfolio management as well, because the chances of success are so small that you need to throw all the energies of the VC team to the companies that have the better chances of doing it. And it's not a short journey. The other feature of unicorns is that there is typically more capital than the average company. Because, to create a winner, surprise, surprise, you need better teams, you need more capital expenditure, you need more investments, you need longer time to profitability, you need negative EBITDA for longer. So that's another thing. Why are VCs pushing you to be profitable next month? These are not good guys, right? Good profit margin, positive profit margin is good. Positive EBITDA is for later, right? We need to absorb cash, to invest, to create a company that is superior to everyone else in that same problem-solving vertical, right? So the other notion is that when you go to a VC and you articulate your pitch, be very transparent about how much money is really needed to be successful. Because if it's too capital efficient, it's usually too good to be true, right? So another feature is that we need to make sure that the good companies, the ones that have the better upside, are properly funded. Otherwise, we will not be able to create winners. Another point is that, and it's not surprising, as you invest in later stage, the probability of picking a winner goes up, right? Of course, the returns go down because the entry price goes up as well. But fundamentally, if you invest in a Series A, there's only a 3% probability of that company becoming a unicorn. If you do 8 financing rounds, by the time you raise your 8th financing round and you have survived and you continue to be an attractive investment proposition, 1 out of 3 of those companies actually become unicorns. So the notion is to be patient and open the fact that unicorns appear at different stages. So it's very exciting to back early stage companies, but it's also important to remember that sometimes the winners emerge later, right? There's another point that it's obvious when you look at it, but not when you sit in front of a VC, is that, surprise, surprise, when there's a more evident upside, the entry price is higher. So when VCs see an entrepreneur that has a significant upside, just make sure you manage to get into that company. Don't worry about negotiating the entry price too much, because the KPI is market share of unicorns, not how much did you pay for them, right? Within reason. I'm trying to be black and white here. There's a lot of gray, but just to make sure that we have clarity on what does it take to actually create winners on the entrepreneurial side and on the VC side to be able to recognize them and to behave rationally when we see them. One last point that I want to make is that VCs are typically arrogant, more arrogant than the entrepreneurs, and they think that they add a lot of value. They don't. They provide capital, right? So we very often say, we help business building, of course we try to be as helpful as possible, but when you actually, rather than second guessing, you go and count, and you ask entrepreneurs and VCs, what do they think about the value add? This slide fundamentally says that, on recruitment, introductions, growth, follow-on financing, other things, the VCs always overvalue their ability to support, and the founders actually say, no, they are not that helpful. The one dimension where we agree with the entrepreneur is capital. So we are called venture capital, not venture assistance, for a reason. Because our role is to give you the money to do what you think you should be doing to grow the company, right? You are the expert in climate, not the VC. Whatever we say, you are betting your life and your professional career on something. We are betting, 20-something every 5 years, right? So, of course, you are more competent than we are. So this is just to say that while VCs are very keen to be helpful, as entrepreneurs, you should recognize that the most important contribution is to give you the right amount of money and to help you raise the subsequent funds as well, right? So there's a number of things that are needed in climate investing and in general in Africa VC to make sure that we go for the real nature of venture capital and tech entrepreneurship, which is to make an effort to create companies that are very valuable, because with 4 or 5 billion a year, Africa will not go very far. We need 20, 30, 50. And in order to attract that, it's not the pitches, it's not our slides on demographics and whatever, it's going to be returns. Because global capital has options all over the place, and they will not pick the best available African opportunity. They pick the best available global opportunities. So I get crazy when I hear things like, oh, for being an African opportunity, this is not bad. That's an insult, right? We need to be world-class and happen to be African, right? So that's fundamentally the message. So conclusion. VCs have a big responsibility in moving the needle from what we are now, which is a small initial emerging reality, Africa VC. It's 4 or 5 billion, means zero globally, right? In a 300 billion global VC market. And what can we do to make better choices? The first is making sure that you realize that VC is not a consensus business. In fact, contrarians win. You have to be contrarian, but you have to be right, right? So within the VC firm, there must be mechanism of leaving space for people who say, no, I don't agree. And let's do what I say, because the contrarian view is the one that takes you there. And the other thing is that we tend to have a tendency to hire the best people on the investment side. But in reality, it's very important to have high-quality people in the entire team, because the investment team must be focused on talking to entrepreneurs, picking entrepreneurs, helping entrepreneurs, exiting entrepreneurs, and you don't want to be distracted. So once again, we need more capital, particularly in climate where many of the business models are quite capital intensive. And in order to do that, we need to deliver world-class returns. And world-class returns, there's nothing to reinvent. VC has been around for 80 years, and these are the features. And so never blame the entrepreneurs, blame the VCs when these things don't happen. Because the entrepreneurs in Africa are world-class. The size of the market opportunity is gigantic. The role that technology can play is infinite. And so if things don't work, is because as an ecosystem, we're not able to pick the right entrepreneurs and to support them, et cetera. But never have the risk of thinking that the problem is because the entrepreneurs are not good enough. No, the entrepreneurs are terrible, just like everywhere else. We look at 12 to 1,500 entrepreneurs a year, and we invest in 4 or 5, and we still make mistakes. So Africa has a world-class entrepreneurship and more than world-class market opportunity. And so let's try to fix the VCs to make them as good as the entrepreneurs. Thank you. I guess we have questions.
Thank you. Can you hear me?
You can just speak louder.
Thank you. My name is Leonard, founder of Tafrija African Accessories. My question is around, you've mentioned that good VCs will not focus on the profits, on the profitability of early stage startups that they are funding. But that is usually counterintuitive for most African entrepreneurs, especially when you're starting. You feel anxious when you're not making profits. So maybe what will be the metrics that early startups should focus on, other than profitability, that will perhaps increase their chances of succeeding in the long term?
So profitability, actually, for whoever has done any basic accounting, you know that there's different level of profit margins. The key for early stage is to have business models that are very high gross margin, right? In other words, every time we sell one of these, we make more money. And so the higher the gross margin, the shorter is the run to real profitability, which is the bottom line, which is EBITDA, right? But the way to create large companies is to pick business models that have high gross margin and invest, lose a lot of money, absorb a lot of cash, because that business model must have the promise at critical mass of becoming a fountain of cash and a lot of cash generation. So it's very important to distinguish full profitability which is completely full for early stage startups, and which is why when I see private equity funds doing the VC game, it's a tragic, terrible thing happening to the ecosystem, because they're asking for, what was the EBITDA for this company over the last 3 years? The company didn't exist 1 year ago, so why are you asking, right? So again, I think profitability is important, but there's different level of profitability that are important at different stages of the... Now, there are business models that are very useful and have intrinsically very low margin, like food distribution, right? Very low gross margin. Some logistic business model, very low gross margin. It doesn't mean they're bad companies, it's just that they're not fit for venture capital, because venture capital is looking for high risk, high return, and those companies are a little bit more predictable and do not offer the fund returning opportunity. But there are other forms of financing that are good for those. So another important point, which I'm sure has been done too boring during the day, is that depending on the business model, you want to look for different sources of capital. So venture capital is just a subset for those companies that have the opportunity, if things work, to be extremely valuable. Yeah.
Thank you. That was a great speech. So you've mentioned that out of the about 300 billion global VC market, that Africa is taking about 3 to 5 billion, right? So that's about 1%. What do you think is the main reason? And it's more of a chicken and egg question, because you did mention at some point that if there are high return businesses, then global capital will come. But you also said that to some extent, VCs are responsible for picking the right entrepreneurs, of which you believe that they're high quality entrepreneurs in Africa. So essentially what I'm asking is, what is it going to take for the attention to shift towards African entrepreneurs so that we can start to see a bigger percentage that's commensurate with the opportunity in Africa? Is it simply that we need more success stories, or we just need more global capital choosing to allocate time and money to Africa?
So I think that is not really rocket science. When you think about, say, 3 billion a year, and you think about an average investment of 3 million, it means that you have 1,000 investments per year, right? How many of those are good investments that over the year can become unicorns, right? Over the last 5 years, Africa has generated, depending on the way you count, 10 to 12 unicorns. And they are now worth about 5 to 7 times what has been invested in them. Which means that it is possible. You know, gravity works in Africa just like everywhere else. Normal venture capital without impact, without grants, without all the support features, Africa shouldn't be treated differently. So we have enough money to trigger the cycle of creating large companies. And that's why I'm saying it's the VCs that have the responsibility to use those 1,000 bullets a year well, because if we manage to create 10 unicorns a year over time, we will have a lot of them that will be there in 5 or 10 years, right? And it's not about how many you lose, it's about the magnitude of the winners. So it's fine, the ecosystem should learn to celebrate when we unplug a company that doesn't work. We throw a wild party. This company is not going anywhere. Unplug, fold. Yeah, it's a great day for the ecosystem. As good a day as when we actually coin a new unicorn. Because it means that the minds, the energy, the capital, the attention is progressively focused towards those who have the best chance of showing the world that Africa can be an attractive VC asset class. So I think that to break the circle is not really a chicken and egg. It's, the VCs should actually start to be less chickens and do more investment that have the right level of risk, which means most of them will go sideways, which is exactly what should happen.
Hi, thank you. So it sounds like a little bit of mentorship and support might go a long way to helping the entrepreneurs that get the money. Do you partner with organizations that have mentorship, or are you looking to put more money into mentorship in your own organization? Because if we're putting money into an organization and just sort of hoping and praying that their team will manage, it feels like there's a little bit of a gap where we could help them a little bit more. Do you agree?
Yeah. So let me tell you what happens in a year, right? Say we see 1,500 companies, we do a first sort of 100 to 10 filter. And so we actually really sit down and interact with a tenth. So call it, say, 150 companies. So once we talk to them, then we are friends for life, right? And so we want to continue to be advisors. We want to continue to be, know what's happening. Very often, our best companies have companies that we passed and they have come back. We decided to launch a small 5 million pre-seed program to make sure that we would capture those entrepreneurs that we were missing, because by the time they get to seed, you don't see them. They don't even go to market. They stay with the people who gave them money at pre-seed. So I think that there's an opportunity to maintain the relationship with all the entrepreneurs that you meet. Of course, we give more time and capital to the companies that we invest in. But we feel we have not necessarily an obligation, but it is actually a selfish interest to continue to be in touch with the entrepreneurs, because they change their business model, they close a company, they start a new one, and if you be helpful, they tend to come back to you. That is one point. The second point is, can we start having mentoring programs for VCs as opposed to entrepreneurs? The entrepreneurs don't necessarily need a lot of help. VCs need a lot of help, right? I see a lot of okay, not great VCs and a lot of great entrepreneurs. So when we have all these poor entrepreneurs that receive offers for help from any corner, leave them alone and do their job, and let's try to help the weak VCs to become better VCs. So when you think about your next mentoring program, think about how to make better VCs rather than better entrepreneurs. You get the last question.
Okay. Hello. What are some indicators of high quality teams, especially during execution for an early stage startup?
I'm sorry, I didn't.
What are the indicators of a high quality team on your second point, especially during execution for an early stage startup?
Yeah. So the dream founder is a return entrepreneur, somebody who's done it before. Whether he failed or was successful, completely irrelevant. But if he's trying a second time or a third time, boy, we want to talk to that person, because he will make new mistakes, but he will not make a number of mistakes. So the first KPI of an attractive founder is done it before. The other is he alone? Is he with other co-founders? Usually co-founders have a higher probability of success of solo founders. And why are they doing what they're doing? And what is their competence? So the point is, tell me about the need that you are solving, and tell me about why you're better than anyone else in solving it. And that is the articulation of the strategy. And there's another one, which is, have you ever done anything like that before? Have you ever recruited people? Have you ever raised capital? Have you ever sold anything? Have you done marketing? Have you managed the technology? So it's about signs that they know what is expected of the leading team over the life cycle of the company. And of course, you'll never be able to predict, but you have some evidence that the chances are that people who have done it before or are more aware of what's needed, they would be more successful. But by far the highest indication of a potentially great founder is that this is not the first time he's doing it. Thank you.
Thank you so much.